We are now in the fourth quarter of the year, which means you have less than 3 months to make sure that you have all of your ducks in a row. You do not want to wait until December to try to figure out your tax savings. Unless you're watching this in December, then you're really running out of time. Now, this video may be about high income earners, but it is really for everyone looking to reduce their tax liabilities before the end of the calendar year. And for tax purposes, the IRS defines high income earners as someone or a household in the 30% tax bracket. So to be specific, if you're single or a head of household making above $191,951 a year, or a married couple making $383,901 a year, then you are in the 32% tax bracket and considered a high income earner in the eyes of the IRS. That's a really good problem to have, but 32% of anything you make above 192,000 or 384,000 is going to the IRS. If it's just $1, that's 32 cents on the dollar, but when it's $1,000, that's $320 to the IRS. So let me show you 5 ways to reduce your taxes before the end of the calendar year. So what does it mean to reduce your taxes? Let's say you're single, making $220,000 a year in adjusted gross income, then $28,000 of that will be taxed at 32%. If you want to reduce that to 24%, then you can put that $28,000 in pre-tax dollars into some accounts that will grow tax deferred. So putting $28,000 into a pre-tax investment account or something else, then you would save a total of $8,960, because if you multiply 28,000 by 32%, it gives you $8,960. That makes sense so far, right? Then your modified adjusted gross income will be reduced from $220,000 to $192,000, which will put you back in the 24% tax bracket. So what accounts can you use to reduce your marginal tax rate? Let me first show you how tax loss harvesting works. Tax loss harvesting is a tax strategy that involves selling your investments at a loss in order to offset or reduce ordinary income tax or long-term capital gains tax. In this video, I'm just going to go over how you can reduce your ordinary income tax, and tax loss harvesting is most beneficial for high income earners in the 32, 35, or 37% marginal tax rate. The higher your income tax bracket, the bigger your tax savings will become. And the deadline for doing this is December 31st of every year. There's no grace period for this tax strategy. And the maximum you can write off your capital loss every year is $3,000 or $1,500 if you're married and filing your taxes separately. So in other words, if your household taxable income is $380,000, if you sell your investments at a loss, it becomes $377,000. So if you lose more than $3,000, like let's say $5,000, then the remaining $2,000 can be carried over and deducted on tax returns in future years until you've used up the entire amount. Now, you have to be careful with what investments to sell by keeping your long-term investments and short-term investments separate. I'm going to use an ETF as an example. Let's say you bought $10,000 on an ETF less than a year ago. Now, it's down by 50% or to $5,000. If you sell this ETF for $5,000, you're going to have a $5,000 loss, right? Assuming that you don't sell any other investments at a gain, then $3,000 of that $5,000 can reduce your total taxable income. But that remaining $2,000 will have to be carried over to the following or the next tax year. So if you're at the 32% marginal tax rate, that $3,000 will save you $960 in total tax savings. If you're at the 35% marginal tax rate, that $3,000 will save you $1,050. If you're at the 37%, then you'll save $1,110. You don't even have to sell your entire investment. You can choose specific tax lots in your investment that show short-term capital losses. You'll need to click on cost basis to find out which ones are considered short-term. And remember, tax loss harvesting only applies to your taxable brokerage account and not your 401k, 403b, IRAs, 529s, or other tax shelter accounts. And here's the most important rule to remember, and that's the wash sale rule. And if you sell it in the ETF at a loss, you can't buy it right back within 30 days. You have to wait until 30 days have passed to buy the same or substantially similar ETF. So selling VOO or the S&P 500 ETF from Vanguard at a loss and then buying SPY within 30 days, which is the similar S&P 500 index ETF, then you're going to lose the ability to write off your tax. And the last thing to remember is that don't sell investments just to write off your taxes. For example, just because your stocks, ETFs, or mutual funds are down, it doesn't mean that you should sell them if you think there's a potential growth in those investments. Like when the S&P 500 index fund was down 18% in 2022, I didn't sell them just to write off my taxes. I knew that they were going to grow in the long term, and they did it in 2023 and 2024. You need to make sure that it's a loss that you're comfortable removing from your investment portfolio for the foreseeable future, unless you have a strategy in place to buy it back after 30 days have passed. And if you're interested in joining my private client program, you can schedule a 60-minute consultation with me by visiting firestation.com/consultation. You can also join my private community by visiting firestation.com/community. And the other way to write off your taxes is by contributing to your health savings account. In order for you to open a health savings account, your healthcare plan needs to be in a high deductible health plan or HDHP. You'll need to check with your insurance company to find out if you're in an HDHP. You can check out this video for the full HSA tutorial. Anyway, if you're watching this in 2024, you have until April 15, 2025, or the tax deadline to contribute up to $4,150 for self-only coverage or $8,300 for family coverage. If you're over the age of 55, you can also contribute an additional $1,000. So let's just say that you're under the age of 55. And if you're in the 32% federal income tax bracket, you could save up to $1,328 in taxes as an individual, or $2,656 if you're on the family coverage and filing your taxes jointly. If you're in the 35% federal income tax bracket, you could save up to $2,905 for the family coverage. And if you're in the 37%, then you could save up to $3,071. And in the tax year 2025, you can contribute up to $4,300 for self-only coverage and $8,550 for family coverage. Regardless of your tax rates, you can save some significant taxes by contributing to your HSA while the money inside your HSA grows tax-free. And not to mention that you can reduce your state income tax by the HSA contributions. The only exception is if you're a California or New Jersey resident. So if you live in California or New Jersey, you can still write off your federal income tax, but you won't get the tax break from your state income tax. Additionally, HSA contributions can also write off your Social Security and Medicare taxes, or FICA, so you can save another 7.65% in payroll tax. And I love the HSA, and I always prioritize my HSA contributions because of the quadruple tax advantages. You can contribute in pre-tax dollars, grow tax-free, and withdraw tax-free for qualified medical expenses. I can also use it for non-qualified medical expenses after I turn 65 years old, and I would only owe federal and state income tax. And another way to save taxes is by opening and contributing to the flexible spending account, or FSA. And keep in mind that an FSA is not the same as an HSA, but they have specific rules that come with it. If you contribute to an HSA, you cannot directly contribute to the healthcare FSA. However, you can contribute to what's called a limited expense healthcare FSA, which covers only your dental and vision expenses at the same time you contribute to your HSA. For either one, you can contribute up to $3,200 in pre-tax dollars. You can save federal income tax, Social Security tax, and Medicare tax. But just remember that you can only contribute to one of them. If you have an HSA, only contribute to your limited purpose FSA. If you don't have an HSA, then you can contribute to your healthcare FSA. However, there's a maximum carryover amount of $640 for the tax year 2024. So if you go over the contribution limit, you're going to be charged a 6% penalty and regular income tax. And something else to keep in mind is that if you leave your job or don't spend your FSA within the plan year, your employer is going to keep your FSA money. Unless you're like giving your employer free money, you need to keep track of your FSA expenses and make sure you keep it under the maximum carryover amount of $640. When the 2025 numbers come out, I'll be sure to make a video on it, so be sure to subscribe if you haven't done already. Your employer might also offer what's called a dependent care FSA up to $5,000 per household. You can use it to pay for your child's before and after school care, babysitting and nanny expenses, daycare, preschool, and even their summer day camp. this FSA only applies to kids under the age of 13. Some employers even offer an adoption FSA, but there's an income phase-out range, so please keep that in mind. It can be a great way to save money if you're looking to adopt a child in the near future. And the other way to reduce your taxes is by making donations to charities by using a donor advised fund, or DAF. Now, I'm not saying that you should donate money like Bruce Wayne, but there are easy ways for you to reduce your taxes by donating to qualified charities. Giving non-cash assets is almost always more tax advantageous than using cash to donate. So again, you can open what's called a donor advised fund, or DAF, with a broker you have a taxable brokerage account with. So instead of selling your stock, you can donate your appreciated stock held for more than a year directly to your DAF. So donating your shares directly to charity will save you long-term capital gains tax and reduce your overall marginal tax rate. I have Vanguard, Schwab, and Fidelity, and I know all of them come with their own version of a DAF, but they all work pretty much in the same way. You can also name the DAF you open, so I can name it to something like the Fireside Chat Foundation or something like that. You can name yours the Batman Foundation or the Pikachu Foundation, whatever name you think is cool. And if you have a 401k or IRA withdrawal in the future that you want to reduce your taxes on, you can roll some of that or all of your distributions directly to a DAF to eliminate your tax burden. This is pretty common for people who have to withdraw their 401ks or traditional IRA due to an RMD or require minimum distribution. The other way you can do with a DAF is by buying stocks directly in that account and let it accumulate. And as the investment appreciates in value, you can donate that directly to a charity of your choice. And lastly, you can save taxes by maximizing your 401k contributions. If you and your spouse both have a 401k separately, then you could save twice the amount of taxes. And it just needs to be in a traditional 401k, 403b, 457, or TSP. So if you contribute $23,000 to your traditional 401k or 401k Lite plan, the 32% marginal tax rate will save you $7,360. And if you're in the 35% marginal tax rate, you'll save $8,050. And if you're in the 37%, you'll save $8,510. And if you're over the age of 50, you can make an additional catch-up contribution of $7,500 in the traditional 401k or other traditional employer-sponsored retirement account. That's going to save you an additional $2,775 if you're in the 37% marginal tax rate. But something to keep in mind is that starting on January 1st, 2026, individuals making more than $145,000 a year will have to put their catch-up contributions, only the catch-up contributions, in a Roth 401k, Roth 403b, or Roth TSP, which means those catch-up contributions will have to be in after-tax dollars. So you have 2024 and 2025 to save taxes on the catch-up contributions if you elect to put them in the traditional 401k. And let me know in the comment section down below if you're interested in watching a video about how to write off taxes as a business owner or a side hustler. You can also get your free financial resources by visiting firesidechair.com/resources. And this has been another beast of a video, and I hope you got a lot out of it.